Hello to everyone from where you're watching us from. Thank you for making good choice by watching our videos, but also thanks for showing us love by liking what we do. So now today I want to take a look at the annual tax obligations. You want to see what you need to do on annual basis as a taxpayer. You could be a company, you could be an individual, you could be a partnership, it could be an NGO, it could be a school, it could be an institution. What do you need to do as a taxpayer? For which taxes do you need to pay on an annual basis? Now, there are two forms of taxes that you need to pay on annual basis, and one is a provisional income tax. Provisional income tax, this is like you are assuming that you make a certain amount of profit or a certain amount of income at the end of the year, but you haven't entered into that year. So, for instance, we have entered the new year, 2025, 2026. The provisional income tax is now going to be paid in the first 3 months of the first installment must be paid in the first 3 months of the new financial year. So you are required to submit a provisional income tax return, and that is done online. And then after, a provisional income tax return shows the amount you expect to earn. If, for example, you assume that in this coming year, depending of course on the past events, you look at the last year how you performed, and you assume, depending on how we are performing, we are likely to make, let's assume, income of 200 million in this coming financial year. And therefore, if you get that 200 million as revenue, we raise all the expenses. We are likely to remain with, let's assume, 80 millions as chargeable income. So you put that 80 as chargeable income, and of course, by default, if in the company, you put 30% of that, and you are allowed to pay it in installments. So the first installment, meaning the first return, the return must be submitted in the first 3 months of the financial year, and then the resultant, the provisional income tax, must be paid in installments. So you can pay it in 2 installments. That is provisional income tax. Two, there is final income tax. Income tax final. In this one, we look at uh, we look at uh, we look at actually what you actually made in terms of the profit. If provisionally you were estimating that you are likely to make 200 million as revenue, so if there ends, what have you actually made? If you were estimating to make 200 million, and in actual sense, after the period you make, let's assume 300 million, meaning that income tax now will have to increase from what you had provided. So in that case, this income tax shows what you exactly received and what you exactly spent. So it will show the actual annual income. So this one, for example, you can take a look at this year that has ended, or this year that you have begun. Now, the income tax final, the company must submit a return in the first 6 months of the next year. So if this year it will end in on the 30th June 2026, then the final income tax return must be submitted within the 6 months. So it is from July to 31st December 2026. That is the income tax final, the return for the year 2025 2026. The deadline is 31st December 2026. So in that, of course, in that income tax return, you declare all the income, you declare all the expenses, and then you remain with the chargeable income. But also you show off, you bring out all the assets, you bring out all the liabilities, you bring out equity section, and then after you show if they are reduction you claim you triple startup costs. And then in that where income tax return. Now, who are liable for paying income tax? Of course, individuals. In this case, when I talk of individuals, I mean individuals, people, and like James, an individual can be James, James, individual can be John, mhm, John. An individual is earning income. Let's assume maybe he's a sole proprietor of a certain business. So what we do, we look at expenses that are related to the business. If, for example, is dealing in buying and selling of rice, if he's paying off-roaders, if he's paying carrying works, those ones are allowable deduction. Those are allowable expenses. But if he goes ahead to buy produce for the girlfriend, in that case the business is making loss. If he goes ahead to make donations to non-qualifying entities, then in that case, uh, that expense is not allowable and they are added back. So what we do, we raise all the allowable expenses and we add back the non-allowable expenses like that chargeable income. That chargeable income for an individual we apply the tax rates. Tax rates, and of course we must note that we have resident individuals and the non-resident individuals. We look at if that individual is a resident, we use the tax rates for resident individuals. But if that individual is a non-resident and we have parameters for one to become a resident individual, what shows? I think I will prepare another video explaining what shows that this is an individual who is a resident and this is a non-resident individual. I can promise that I will prepare that for you to understand these concepts. And also, I want to empower you to subscribe such that whenever we share a video, you are able to get very fast. You are able to be notified fast by YouTube that we have posted video. Then, income tax is also payable by non-individuals. In this case, we are talking about companies. Company can be a company limited by shares. It can be a single member company. It can be an institution like a university. It can be a school. It can be like that. So in this case also we look at allowable deductions. We also look at non-allowable deductions But also we can claim sector allowances, whereby you have the info allowance, costs, you have wear and tear on property, plant and equipment. But also we can have, for example, you're dealing with farming, you have that farming allowance for farming deduction. So in that case, we get the chargeable income. That chargeable income is subjected to the tax rate in the country. We get the tax payable as tax, income tax rate. So that is related to one individual. Then partnerships could be a combination of two or three, two or more individuals doing business in common with the purpose of earning profits. So what we do in this case, we now look at the profit of the partnership. Then after distributing in their profit sharing ratios, in their profit sharing ratios. Then after we look at what each partner has received as income. So now we look at all other incomes that a partner got during the year. We add them to get the total income of, of the partner. Then after we apply the tax rates. If that partner is a resident individual, we use tax rates for resident individual. But if that partner is a non-resident, there is a schedule also of tax rates that we use to tax this partner. So partners, partnerships do not pay taxes. Only the partners are the ones who pay taxes. So we share the profits from the partnership. Then after we see each partner is John, how much has John shared? Then we fix that amount of money using the tax rates. If that John is a resident individual, we use tax rates for resident individual. So like that is that. So those are tax obligations that are annually at your hand as a taxpayer. Then we emphasize this, a taxpayer can be an individual. Also a taxpayer can be an individual. So now you need to understand this knowledge is very important. You need to understand your annual tax obligations. You need to understand what you need to do as a taxpayer. If you have a company, be vigilant. Be vigilant. So thank you so much. Hit the subscription button such that when you share another video, you are able to get notified by YouTube. Thanks for the love. May God bless you.